and those generally get taken out pretty easily. That's the same concept that I marked out and showed you guys on Discord, that all these highs here, all of these are bad in the sense that no candle took the liquidity of the previous one. For example, this is something very typical for you guys to see on BTC at least, which is, for example, even though these are bad highs, price just a lot of times just tends to recover to where there are vectors to recover, have some small of wick, some sort of wick, a smaller one, maybe a doji, maybe a hammer, inverted hammer, whatever, and then have a reaction, an opposite reaction. But if price is actually intended to go up there, this should be no resistance. So in theory, all this general area was a good place to long. I think I have this here. Oh wait, did I change charts? No, I didn't. In the beginning of the stream, oh, there it is. Okay, never mind. I was going to say that I lost my folder, but there it is. So this is, for example, a 10-minute block. Here's another good example. You have this range. Okay, this whole range. Before price starts moving up, this green candle takes out the liquidity, right? So you are left with one candle there that was basically the last contrarian candle to the intended move, and that was basically the supports that was needed for a continuation move. Okay, those are essentially the types of blocks that I like to trust in, because everything else, they may work sometimes, but in my experience they're a little bit more unpredictable, and they don't generally they don't generally give good results. For example, we have another case here. This is the setup that I gave you guys, where I told you that looking at the 15-minute, looking at the 15-minute, we only had this and this vector that started going down, right? If you come here, imagine you see that range forming. You see this range here forming, okay? And for example, there's no liquidity sweep unless you count this candle here. But this candle, for example, did not take the high of that candle over there as well. However, if you go lower, you'll see that the first real vector, the first real strong candle that broke out of the range was this one, which took out the liquidity of the previous candle, right? So this candle over here, this is your block where price might have a good reaction from, and the only problem in this case is that your risk to reward is a little bit lower, and the only reason that I had my take profit plan there was to target that low for a possible continuation. However, in this case, you should not target lower than this, even if you have good reasons to, exactly because this high did not take out that high, nor did it take out that high, and you can even go further back. This candle here did not take that guy and that guy, so on and so forth. So all of this is basically a liquidity curve, even though it doesn't really seem like it. So for example, this trade here would only be probable to target this low, but other than that, it might be dangerous. Also, we had another confluence for this, which is, and now I'll go over the logic of TR pockets as well. So you guys have a big impulse move. It ends here, right? The impulse itself ends here. When you have this move ending here, you draw. Let me just change this to a TR pocket. Okay. When you have this here, you draw a TR pocket from the high, the end of the impulse move, to its correction, which was here. Okay. Over there. This is on the 10-minute, can be on the 15. Okay. But generally also the 5 is nice to see these kind of things, kind of levels. Okay, so the moment that you have this and that you do have a clean reaction to one of the levels, that is kind of like your confirmation that this TR pocket is very likely to be respected from for the remaining 3 levels. So if you have a good reaction to this one, you can actually look for a trade right after this, like a short trade. But then until you get out of this whole range, which is from 42 to 44, this TR pocket is valid in terms of possible reactions to the remaining levels. So you would exclude this level, but you would consider, or have to consider, that a reaction from this level is possible, and from these 2 below are also possible. Okay, so following that same logic, the highs that you now have are basically from here, this high and this low, right? Now locally, just looking for example, let me move the replay. If you draw market structure, for example, you would do something like this. So come from the impulse move, come up here, come up here, and come up here, and then you did not make a lower low. Right off the bat, you can make a smaller TR pocket from here to here, and you have a very beautiful reaction there. Why do you do this? Because this high did not surpass that high, and this low did not surpass that low. So you are basically inside of a range, right? The moment that you are inside of a range, the TR pockets are nice to calculate probable deviations that will maybe either give you a possible continuation or just be levels that can give you oh sorry, wait, this was badly drawn. So, or give you reactions for another continuation, the rest of what you are expecting. So this TR pocket, for example, the moment that it gave out this beautiful reaction to the 272, this would be your trigger signal telling you that, okay, price will probably not go lower right now, and it can actually reach one of the previous TR pockets, which is like a larger macro. Well, it's not macro, but it's a larger TR pocket, so it's a bigger picture, right? And if you notice, not only did you have a beautiful reaction here, but then this 618 here is also perfectly aligned with that high. So the logic here is that you have now 2 confluences that price will have a decent reaction to the 272, and you should at the very least expect price to come to 0.5, which is basically the middle of this range, right? So going to the middle of the range in this exact case now is very likely. I'm gonna explain my logic. High, sorry, it's not there. You get that high, You get this high, and you get a range inside that, right? This guy did not break that high, and it corrects and then creates a lower low. This is another range because you then have that a high also not breaking that. You draw your TR pocket, and now if you actually get a reaction, okay, which you do, you can see that we are this 5-minute block, for example, it's on the 0.5 level, which is a lot of the times the only level that price reaches if it intends to continue dropping. So the moment we created this like lower low, lower high, the bias would be that we are going downwards, also based on the idea that we had, if you remember, this first reaction to this TR pocket. So two things is that if we had a reaction to the TR pocket from the upside, one of the TR pockets from the upside, now you would probably have a retrace to one of the TR pockets on the lower side. So our bias is lower, right? However, after getting this reaction, getting to the 0.5 is a probable target, but it doesn't mean that price can't go to one of the higher ones above, because a range is always a range until it stops being a range. One of the things that I don't know if anyone here has the Phoenix. I know Elena has, but one of the things that you will hear Phoenix talking about is, until you get out of the range, just trade the range. So just trade the highs and the lows. And in this case, for example, the 0.5 is the probable target, but you have no absolute guarantee that price cannot just take all these highs together if there is enough follow through by the bulls. However, because we had that 5-minute order block just at the 0.5, and because our bias is that after going to the upper TR pocket, we are probably headed to one of the lower TR pockets, it is, as a probability game, as a probability point of view, it is still likely that you can continue going down. Okay, so for example, this would be your first possible trade as a conservative entry. And what I mean by conservative entry is that, for example, if you draw a Fibonacci from here to here, a normal one, I generally consider the 0.5 and the 618 as a conservative entry, in the sense that it might not give you the best risk to reward, but you are most likely to get in, because a lot of the times price retraces more, but in any case you are most likely to get in at the 0.5, which is okay. It's the middle of the PD array, right? The premium discount zone. But for example, if you enter on the 618, it gets a little bit better in terms of risk to reward. But a really good one would be the 786. And for example, the 786 is right. This was a BPR. In case someone doesn't remember what a BPR is basically when imbalances overlap. So if we go to the 1 minute, it's not this big, but you can see that in this general area, like so, this zone, you don't have any wicks, right? And in between this space, this orange space, you don't have any wicks. I'm gonna zoom in just for you here, since you're on your phone. But you don't have any wicks, right? So that is a balanced price range. Is a place where price tends to recover, but sometimes it's enough for it to actually react from. So this would be your primary entry, and your stop would have to be a little bit above these highs or just above one of the highs. In this case, this is a very small range. Like this is 4 minutes, but this candle did take out the range of the liquidity of that range before going down, right? Also, there's the theory that price, as you can see, besides this red candle here, there are no vectors to recover, right? None. This pink one was recovered with these white candles. So this is just like the last vector to recover. There's nothing more. Even if you look at the previous highs, you only have this wick. But for price to get up above this wick or reach it, it would need to have intention of taking this high and that high and that high. So in theory, this is a safe high. Just focused on the logic that it took out that liquidity and it's not a vector. Okay, so but again, playing it safe, you would want to only take out that low, nothing more. I don't remember if we actually reach it, or if we go to the second trade. Maybe. Okay, we reached it. Equal lows, maybe. 609.9. Okay, it was an SFP by $2 in a $44,000 asset, but okay. So let me fast forward. I know that we eventually reach those. Oh, this is too slow. Let me change to 15 or something. Okay. Okay, yeah. Oh, I'm just noticing it that the SR flip that we drew right on the beginning of the session, it was a place of reaction as well. Okay. So that gives us further confidence for a possible long now from that level. Okay, so yeah, we would then reach it, and then notice that this was, if I'm not mistaken, yeah, one of the 3 setups that I gave you guys. Like, and I gave you guys this setup based on this move, which happened on the 5th of December. Shortly after I gave you that move. The idea again is just the TR pockets, and it's for the logic that we still have a bias for more upside, right?